You've seen it happen, right? The Fed makes an announcement about interest rates, and boom, the stock market reacts, sometimes in a matter of seconds. But why? What's the hidden connection that ties the cost of money to the value of the world's biggest companies? Well, today we're going to pull back that curtain and figure it out together. So here's our game plan. We'll start with the Fed's main tool, then trace that classic ripple effect through the economy. We'll look at how bonds suddenly become the popular kid at the party, and then, this is the good part, we'll see when that simple rule completely breaks down. We'll even check out which types of companies win or lose, and of course, what all of this actually means for you. All right, so to really get what's going on, you have to start at the source. And that's the US Federal Reserve, the Fed. Think of them as the manager of the US economy. And they have this one huge lever they pull to try and keep everything on track. And that lever is the federal funds rate. Now, this isn't what you pay on your credit card. Nope. It's actually the interest rate banks charge each other for these super short overnight loans. But here's the magic trick. By tweaking this one single rate, the Fed sets off a chain reaction that affects almost every other borrowing cost out there. It's their main way of tackling their two big jobs, keeping prices stable and getting as many people employed as possible. Okay, so let's get into the basic rule of thumb, the one you hear on the news all the time. The general idea is that interest rates and stock prices, well, they have an inverse relationship. When one zigs, the other is supposed to zag. So when rates go up, stocks are supposed to go down. Let's break down how that's supposed to work. It's really just a big domino effect. First, the Fed raises rates. Then it gets more expensive for your bank to borrow money. So guess what? They turn around and make it more expensive for you to borrow money on your car loan, on your mortgage, on everything. Same goes for businesses. When borrowing costs more, everyone, people and companies, tightens their belts and spends a little less. That slowdown can mean lower profits for companies, and well, that makes their stock look a whole lot less attractive.
But hold on, there's another massive piece of this puzzle, and it all comes down to competition. See, stocks aren't the only option for investors. There's always this other, much safer alternative hanging around: bonds.
So picture this. When interest rates go up, new government bonds get issued that pay out a higher, safer return. All of a sudden, you as an investor have a choice. You can either risk your money in the roller coaster of the stock market, or you can get a pretty decent, almost guaranteed return from a boring old bond. What would you choose? A lot of people choose safety. And that movement of money from stocks to bonds is what we call the Great Rotation. And hey, don't just take my word for it. As Tom Hanlon over at US Bank points out, once bond yields get high enough, they become a serious competitor for stocks. It's a constant tug of war for investors' cash. Okay, so far so good. It seems pretty simple, right? Rates up, stocks down. But here comes the plot twist. It turns out this rule gets broken a lot. The reality is way, way more complicated than that. I mean, if we just stick to that simple rule, then anytime the Fed starts raising rates, that should be terrible news for the stock market, right? Well, what does history actually tell us? And this is where it all gets turned on its head. Just look at this. These are all major periods where the Fed was raising interest rates pretty aggressively. And what happened to the S&P 500? It didn't tank. In most cases, it went up a lot. I mean, look at 2004 to 2007, up 30%. So what in the world is going on here? How can reality be the complete opposite of the rule? The secret, it turns out, is that the reason for the rate change is way more important than the change itself. Think about it. Why does the Fed raise rates? Often, it's because the economy is on fire. People have jobs, they're spending money, and companies are making huge profits. The rate hike is just the Fed gently tapping the brakes to make sure things don't get out of control. So, a rate hike can actually be a sign of a super strong economy. And a strong economy is fantastic news for stocks. And it gets even more granular than that. It's a huge mistake to think of the stock market as just one big thing. When interest rates change, different parts of the market can have wildly different reactions. So, for instance, financial companies like banks, they can actually love higher interest rates. Why? Because the gap between what they pay for money and what they charge for loans gets wider, and that means bigger profits. But on the flip side, you have high-growth tech companies. These guys often borrow tons of money to fuel their expansion. When that debt gets more expensive, it can seriously slow them down. So let's bring this all home. After all this, what's the big takeaway? How can you actually use this information to be a smarter investor and just a more informed person when you watch the news? It's really about changing the way you look at the headlines. The bottom line is this: always ask why. When you hear the Fed is changing rates, don't just fall back on the simple rule. Dig a little deeper. Is the Fed raising rates because the economy's booming? Or are they doing it to fight off scary inflation? The answer to that question tells you way more than the rate change itself. It really is less of a simple rule and more of a complex, beautiful dance. So, the next time you see one of those flashing headlines about interest rates, are you just going to see the number? Or are you going to look past it, ask the right questions, and see the real story that's actually playing out?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.